Hey everyone! Okay, let's dive right into this whiteboard explainer. Today we're unpacking a highly structured blueprint for the 2026 IGSC accounting syllabus, and we're zeroing in on clubs income and expenditure. We want to take you from basic data entry all the way up to A-star financial intelligence, and really decode what the examiners are actually looking for. Mastering this topic isn't just about getting the books to balance at the end of the day. It's an incredible test of your analytical skills. So whether your goal is to secure every single method mark or to perfectly interpret some incredibly tricky ratios, this explainer is a definitive revision blueprint that we're going to explore together. To make our time together super efficient, here is our agenda. We'll kick off with a quick concept recap, move into technical execution, then tackle interpretation and AO3, and finally wrap up with some crucial examiner insights.
All right, part 1, concept recap. Let's look at the new rules for the 2026 syllabus.
So, Cambridge has actually updated their terminology. When an exam question uses the command word state, like state the accounting equation, using the old vocabulary is literally going to cost you marks. To hit that 100% accuracy mark for the 2026 syllabus, you absolutely must use modern international terminology. Think irrecoverable debts instead of bad debts, and owner's equity. Dropping these exact terms shows the examiner you are fluent in the updated vocab, and it instantly signals an A-star level of understanding right from question 1. Now, beyond just the vocabulary, we've got to treat the fundamental accounting principles, like the accounting equation, where assets equals liabilities plus equity, basically like the laws of physics in our whiteboard universe. You have to maintain this equation at all times. But it doesn't stop there, right? You've also got the business entity concept, which means you have to strictly separate the club's finances from the members' personal pockets. Oh, and the duality of every transaction, that just reminds us that every single debit has a corresponding credit. These aren't just definitions to memorize, they are literally the architectural foundation of every account we're going to prepare today. There's actually a super interesting tension here when we look at these principles side by side. Students often violate the prudence concept by ignoring potential losses, which artificially inflates profits. And honestly, that's a massive red flag. Prudence means we never, ever overstate our assets or incomes. On the flip side, though, we have the historical cost principle, which says, hey, record assets at their original purchase price no matter what they're worth today. Balancing these two, especially when you're dealing with tricky adjustments like accrued or prepaid items, is exactly what separates a pretty good answer from a brilliant A-star response. Okay, let's move on to part 2, technical execution. This is all about securing those vital method marks. When you see the command word prepare, like prepare a ledger account, examiners are looking for a very strict logical flow. Here's a huge tip. You are actually awarded method marks, even if your final math is totally wrong, as long as your logical procedure is visible. Seriously, if the examiners can trace your logic from the source document, say an invoice or bank statement, straight through the books of prime entry, and finally into the T account or trial balance, you are racking up points. If you skip showing your workings, you're just leaving easy marks on the table. Drilling down into that T account structure, mastering the gold standard of double entry means knowing exactly when and where to use balance BD, brought down, versus balance CD, carried down. This is basically the heartbeat of ledger accounting. So the balance carried down is your closing figure at the end of the period. It acts as the plug to balance the two sides. The balance brought down, that's your opening figure for the very next day. Mixing these two up is a super costly, yet entirely preventable mistake. Actually, scratch that. It's probably the source of most late-night accounting headaches. Let's pause a second and mentally highlight some massive pitfalls when you're asked to calculate figures. Miscalculating discount percentages, specifically mixing up trade discounts with cash discounts, will completely ruin your calculation before you even get to the financial statements. Another huge one? Missing state symbols in manufacturing accounts or just totally forgetting to show adjustments for things like depreciation and closing inventory. Our goal in this technical phase is absolute 100% accuracy in the trial balance, making your transition to the final statements completely seamless. All right, part 3, interpretation, ratios, and evaluation. Let's master assessment objective 3 or AO3. Okay, let's make this part interactive. I want you to literally pause this explainer for a moment, grab a pen, and try to answer this. Evaluate why a business's current ratio might fall from 2.5 to 1 down to 1.1 to 1. Go ahead, pause it, and try it. All right, hopefully you gave that a shot. You see, anyone can punch numbers into a calculator, but calculating the ratio is just your baseline skill. Identifying what a drastic drop actually means for a business's liquidity, that's the high-level AO3 analysis we're aiming for. True financial intelligence is telling the real-world story behind those numbers. So, did you guess any of these? If you see a ratio drop like that, your mind should instantly jump to a few operational causes. Maybe inventory was massively overpurchased, which means all your liquid cash is tied up on dusty warehouse shelves, or perhaps trade payables are being settled way too slowly. Or maybe your cash reserves are totally wiped out because of a massive capital expenditure, like buying brand new machinery. This right here is the exact analytical toolkit you need to diagnose liquidity or profitability issues when evaluating a business scenario.
Now, these tools are also super essential for inter-firm comparison. But it gets tricky, right? Because businesses use totally different accounting policies. For example, one business might use the straight line method for depreciation, spreading the cost evenly over the asset's life. But their competitor, they might use the reducing balance method, which heavily front-loads the expense in the early years. Because of these fundamental differences, doing a direct one-to-one comparison is honestly pretty tough. You always have to look beyond the surface numbers to analyze the true quality of the profit they're reporting.
And speaking of looking beyond the numbers, we absolutely can't forget the invisible non-financial factors. Things like staff morale, the business location, market reputation. These are absolutely crucial for long-term sustainability. You won't find them anywhere in a T account or a balance sheet, but they heavily dictate the ultimate return on capital employed, or ROCE. When an exam question asks you to advise a business, especially in those big 12-mark questions, bringing these real-world qualitative factors into your evaluation gives you a beautifully well-rounded, impressive answer. Finally, Part 4, Essential Examiner Insights. Let's lock in our 0452 exam strategy.
This is straight from the examiner board. Quote, method marks are awarded even if the final balance is incorrect, provided the logical flow is visible. Let that sink in for a second. Your workings are an absolute lifeline. They're basically your insurance policy for your final grade. If you mess up a calculation early on, but you carry that incorrect number through perfectly correct accounting procedures, you're still going to get the vast majority of the method marks. So the golden rule here, never ever leave your working section blank. Looking at recent examiner reports, they actually outlined a really crucial do's and don'ts checklist. They explicitly stated, and this is crazy, that students are losing points simply because their ledger handwriting is illegible. Guys, it is the worst feeling to lose an A star because your 7 looked like a 1. Also, examiners noted massive failures in distinguishing between revenue and capital items. That means day-to-day expenses are getting confused with long-term asset purchases. Always verify which one you're dealing with. And lastly, time management. You have to manage your time based on the weightage of each question. Spending 20 minutes on a 2-mark question, that is a strategic disaster. As we wrap up this explainer, here is one final ultimate question to test your accounting mindset. When you're tackling these complex scenarios, ask yourself, are your financial records transparent enough for banks, owners, and tax authorities to make critical decisions? Because at the end of the day, they rely on the absolute integrity of these records for high-stakes choices. By applying modern terminology, securing those method marks with clear workings, and evaluating the data critically, well, you're doing way more than just passing an exam. You're demonstrating true financial intelligence. Keep practicing those T accounts, stay sharp on your evaluations, and I'll see you in the next explainer.